Well, welcome. This is Dan Betzel, and thank you for taking time to participate in this next video education workshop called Examining Your Expectations. Let's just get started. Now, understanding the relationship between expectations and results, I believe, is crucial to experiencing peace of mind about investing. No matter what it is in life, expectations about the outcome of some event, it's going to play a deciding factor in how we feel about the eventual outcome. If we never expect anything, then on one hand, we're never disappointed. But realistically, however, it's clear that most of us develop expectations about nearly all aspects of our lives, and perhaps nowhere is this more pronounced or more significant, and also as potentially devastating as when it applies to our investing. So, in this session of your investor education series, I want to help you align your investment expectations with potential outcomes in order for you to try to achieve fulfillment and, uh, and guide you on your journey toward peace of mind with your investments. That's the goal for today. Well, let's begin with what I would call investor illusion number one. I call it the crystal ball illusion. There are several misconceptions or illusions that people have about investing, and I'm going to discuss just two of these right now. One is called the crystal ball illusion. Most of us realize that you can't make important life decisions based on an image purportedly foretold by gazing into some crystal ball. Yet, very often, three commonly espoused methods of investing provide no greater guarantees than using the crystal ball to make decisions about your investment portfolio. Now, we call these stock picking, market timing, and track record investing. And there are these self-described seers, prognosticators, who claim that they can predict the future by gazing into the crystal ball. And we're going to look at these and see how these can actually be very, very damaging to your investing future and your investing peace of mind. Many of you may know who this is. He's a famous author, Harry Dent. He is seen very often on TV shows, and you can find him in the bookstores, often quoted in magazines. And back in the early 1990s, he predicted that the Dow would reach 2000, which it did in 1999. So he was correct. So because of that, all of his future prognostications about the market have been followed, although he has not had the same consistency that he had when he originally started. For example, he wrote a book called The Roaring 2000s, and you may remember that the decade of the 2000s was not very roaring. It was more whimpering. The S&P 500 returns from 2000 to 2009, the U.S. large stock, actually had almost 1% loss per year for a total of negative 9.1% of total return. So just because someone may be accurate and luckily had guessed properly in one time frame, that does not mean that you can rely on them for their future prognostications. Well, illusion number two. The first one is the crystal ball illusion, and the second one is the free lunch illusion. I don't know if your parents told you this, but I was told growing up that there's no free lunch. If something is too good to be true, it probably is. But there are some investors that believe that if they look long enough and hard enough, and they look in the right places, they can get massive returns on their investments without taking any real risk. So they want all upside, no downside. Whenever you hear someone talk about all upside, no downside, I call this the free lunch illusion. For example, let's look at some real life examples of this illusion. In the 1970s, gold went from $300 an ounce to $800 in just a few years. It seemed like such a winning strategy to invest in this commodity, but unfortunately, the fact is that gold thereafter plunged below $800 from the mid-80s straight through to the middle of 2007. So that was one example of a free lunch. Also in the 90s, there were technology stocks, and it looked in the 90s that these stocks were going to go up keep going up and up and up, and that they would become the silver bullet that every investor craves. Then, of course, we had the dot-com bubble burst in 2000. So when investors believe that specific investments or markets will always rise without falling, or there's some investment vehicle that only provides them upside and no downside, very often these expectations for their investment results are going to likely lead to some serious issues, because we know, of course, no one knows what the future will hold, but we do know that past performance is no guarantee of future results. So again, this looks really great, but remember, the bottom line is there is no free lunch, and every investing opportunity entails potential risk, and you as the investor need to be certain that you are sure what that risk is. Now, let's take a little bit deeper look at expectations and results. So, expectation is pursuing a market rate of return. So, one of three things are going to happen, right? When it comes to expectations and results, there are three possible outcomes. You may exceed the expectation, you may and of course, if you exceed the expectation, then you're going to beat the market returns. You may actually have a matched expectation, so what you expect actually happens. You're going to find yourself at that point being satisfied and content because you're going to actually get market returns. Now, in the first one, if you're able to exceed expectation, of course you're going to be euphoric and overjoyed and thrilled. So we have exceed expectation, matched expectation, and the third would be, of course, there's unmet expectation. So your actual result is that your portfolio underperforms market returns, and of course it's going to create a significant amount of worry, concern, and disappointment. So whether or not an investor experiences expected, better than expected, or worse than expected results, it's generally determined by how realistic their expectations are from the beginning. And I want to give you something to think about. I believe that unrealistic expectations are one of the most common reasons that investors experience disappointment and concern about their investments. And today, I want to explore 6 potential breakdowns in establishing realistic expectations. Now, we're going to go through each of these six what I would call unrealistic expectations and show how they can contribute to poor investment choices. So the goal is to align your expectation, your reasonable expectation, with results so that you will be able to work toward meeting your goal of financial peace of mind. So, what causes this breakdown in expectation? First is what I would call hindsight bias. So hindsight bias is the tendency of people to overestimate their ability to have predicted an outcome that could not possibly have been predicted. One of the best examples that you probably have ever experienced with this is what we call like the Monday morning quarterbacks. So you can see this at play everywhere, like in post-game sports talk shows. The hosts and callers often appear to have convinced themselves that they knew in advance that a particular game strategy would succeed or fail. I mean, if you're ever driving in the car listening to this, endless hours are spent on the air second-guessing the coaches and the teams because, in hindsight, these Monday morning quarterbacks, they had a very clear perspective of what the winning strategy should have been, and they just can't understand why no one saw it. Of course, they really weren't able to see it either, because if they had been, then so would the coaches have also been able to see it. But you can always see hindsight bias at play whenever you hear someone say, "I knew that was going to happen." It's a very commonplace tendency, and we've all done it. I certainly have done it. However, the fact of the matter is that none of us can predict actual outcomes in the future with any level of certainty. Only in hindsight does it become crystal clear. But why does this matter? How is this applied toward investing? Because hindsight bias focuses on past events, and it very, very sneakily, it lulls us into believing we had it all figured out all along. And this phenomenon of hindsight bias is dangerous as it applies to investing, because it sets up very unrealistic expectations for the future, and it also, I'm going to show you, can impact our future decisions and actions as it applies to our investing life. Here's a great example, of course, on the Monday morning quarterback, and you'll probably understand exactly what this is talking about the event. I'm Rob Lowe, and I have DirecTV. And then there's another version of it. I'm an incredibly stupid Rob Lowe, and I have the best running back on the NFL, but I pass the ball from the 1 yard line, and I have cable. Um, Funny examples of what it is. But let's look now and see how it can apply to investing. How does hindsight bias apply to investing? Well, between 1977 and 1989, a fund got higher returns than the S&P 500 for 11 of those 13 years. Now, if we compare those statistics to the random flip of a coin, we find there's only a 1% chance of observing 11 or more heads in 13 flips of a coin. So if we use this analogy, it seems as if the fund manager who managed the fund during this period was demonstrating skill and not just random luck. Of course, we know that past performance is no guarantee of future success, but yet when we see that for 11 of the 13 years this particular fund beat the S&P 500, we begin to think, wow, this person must have known something that the rest of us didn't know. But in reality, right, every large brokerage firm has hundreds and hundreds of various mutual funds. And of those hundreds and hundreds of various mutual funds, there is probably going to be one or two that is going to consistently during that period beat the market, while the other ones are not. And then in hindsight, the one that has beaten the market, it is lauded as the great fund, and everyone should invest in it. Now, of course, very often what happens then is that fund going forward, it will fall out of favor. It will no longer be one of the top funds because it really wasn't done because of skill. It was done because of random luck. But yet we use our hindsight bias to convince us otherwise, and to very often lull us into making decisions that are not the best for us and our portfolio. So hindsight bias. How do you guard yourself against this danger? So if you had really known what was going to happen, you would have taken different actions. So this is the reality check, to see whether or not hindsight bias is actually impacting your future actions. So if you really knew in advance that a particular stock or fund was going to do well, you would and should have borrowed money to bet the farm on what you knew would happen. But hindsight bias is extremely dangerous human perception error because it leads us to believe that we have the power and control and insight that in reality we don't have. We cannot accurately predict the future. So of those 500 funds, if you had picked the proper one, or the one that had done better, that would have been random luck. And you would have just been really lucky. And if you had tried to do it again, chances are that you would not have been able to have that same result. So, but it leads us to believe that we can win at Vegas, that we can pick all the best stock pickers in advance, and that we can do all sorts of things that in reality we don't have the ability to do. When it comes to investing in the market, this is an especially dangerous belief that traps many of us. So, let's look at the second way that we can have an expectation breakdown. It's called false patterning. And false patterning is when we as humans, we want to see meaning, we want to see patterns, and we often see them when they're really not there. We identify patterns where none exist. For example, hot streaks. So the second way in which expectations may fail to be realistic is, as I said, called false patterning, which means identifying patterns where none really exists. One example where we see this is when athletes or gamblers experience what we would call hot streaks, such as shooting baskets or making touchdowns or shooting dice. So athletes often have hot streaks and cold streaks at various times in their careers. So for example, a basketball player can experience a shooting streak where every shot seems to whoosh through the hoop. Nothing seems to go wrong, or so it would appear, especially as the announcers excitedly comment on and validate what we're seeing. And yet statistics teach us something very different. While we watch and see hot streaks, hard numbers show that players are just as likely to make the shot after scoring as they are to make the shot after missing. In fact, if we rely and believe the numbers, there are no streaks at all, simply random spurts with no consistent patterns that when looked at from a larger perspective show us that there really is no pattern. This is something that's very, very difficult for us to believe. A very, very well-known and respected economist. Here's a picture of him, Malkiel Burton. He wrote a very, very seminal book on investing called A Random Walk Down Wall Street. And randomness is hard to accept. When events sometimes do come in clusters and streaks, people look for explanations and patterns, and we often see one when there really is not one there. So, as human beings, we are inclined to clarify events, happenings, or activities that we really don't readily understand. Therefore, we intuit patterns that really have absolutely no statistical substantiation, and we mistakenly perceive relationships where none exist. This is the perfect example of false patterning. And the tendency is potentially harmful in investing because it leads us to a mistaken sense of certainty about what's going to occur in the future. And just as we begin to think that we see the pattern shifts. And if we've relied on the pattern to make an investment decision, we can find ourselves being hurt financially. Let's look at some examples of false patterning. For example, commodities. The illusion that past performance is related to future performance is one reason why investment magazines continually publish and report mutual funds performance. Yet they always say that remember that past performance is no guarantee of future results. As documented by the economist that we just discussed, Burton Malkiel, who is a professor at Princeton University, author of The Random Walk Down Wall Street that I mentioned. And it can also be read in the fine print of most investment literature that past performance does not indicate and is not a guarantee of future performance. Well, let's look at this. So here's an example of the growth of wealth. So the blue line you're seeing on the screen is the S&P 500 index. So it's the U.S. top 500 companies. That's the blue line. You can see what happened during this period of September 2007 to June of 2008. It certainly is not doing that great, especially when you compare it to the commodity total return index. That's the green line. It is going straight up. And if you were to look at this, you begin to see a pattern. And if you looked at magazines and listened to the talking heads on the finance TV programs, they would be telling you that this is happening because of this incident or that incident, and it's a new pattern, and we can make money if we follow this pattern. But let's keep looking at backing up and looking at larger time frames so we can see what really happens. Okay, here you see that the $100,000 investment actually would have decreased if it were an S&P 500 index to $88,337, while the Bloomberg Commodity Total Return Index would have actually grown from 100,000 to over 143, almost $144,000. Now let's look at the same asset classes, the S&P 500 and the Bloomberg Commodity, from a little longer time frame, from 2008 to 2014. And if we look at this time frame, you can see that the $100,000 has grown to over $185,000, and the $100,000 in the commodity, it actually lost over half of its value and is now worth $45,250. Let's look even at a longer time frame, 1991 to 2014, and you can even see more dramatic changes here. So we see that the S&P 500, the $100,000, has grown almost to $1 million, $982,000. We can see that the commodity the Bloomberg Commodity Total Return Index has grown from $100,000 to $221,000. So it's quite remarkable when you begin to look at things in a larger framework and a larger picture. So the reality check for false patterning is that no one, not me, not you, no one can predict the future. And if someone does seem to predict the future, it has more to do with just being lucky. So, how does the reality breakdown affect investing? Investors, following the advice of financial analysts and the news and print media, often find false patterns. After technology stocks had 5 years of superior performance, for example, investors were encouraged to believe that a new pattern was emerging where this segment of the market would continue to have double digit returns every year. Many investors and financial institutions chased this new pattern, and they were devastated when the dot com bubble burst. The so called pattern didn't exist, and they were tricked or they were trapped by it. So, false patterning in the investment world is extremely dangerous because it encourages investors to put large sums of money at needless risk. When you combine hindsight bias with false patterning, you begin to see how many people are building their investment philosophy on some very, very shaky ground. Let's now turn to the third way that our expectations can be broken down. It's emotion-based decisions. So emotion-based decisions are basing important life decisions on our emotion or gut feelings. Now, I'm not saying that emotions aren't important. Emotions are extremely important. We make some of the most significant decisions of our life based on emotions. For example, who you marry had a lot to do with emotions. But nevertheless, we have to make sure that our emotions are not being used against us, that the media and the various financial talking heads are not using our emotions to keep us in a position of fear and manipulation to get us, to buy their newsletters and to buy the most recent funds that they're pushing. So the third reality breakdown is this, as I said, this emotion-based decision making. Most of us like to believe that we are logic, like Mr. Spock on Star Trek. When we make important decisions in life, we're taught to value reason, common sense, and sound judgment. But we're only human, and emotions, often negative emotions, can creep into our decision making process and we don't even realize it. Like I said, using emotions in our decisions is not bad. In fact, it can be extremely beneficial as long as we don't use our emotions to distort actual, say, factual data. When emotions drive the decision making process, we generally, what we do is we overweight the data that supports our emotions or our gut feelings, while simultaneously underweighting any data that contradicts those feelings. And the process is here's a kind of funny little diagram that kind of shows this process. So, what happens, we have called the gut filtering system. So, we take our external inputs like statistical charts, financial analysis, media articles, etc., and we pass them through our emotional filter to help us determine what we're going to believe and what we'll discount. If we allow our emotions to be manipulated by other, say, talking heads, what we hear on the radio, what we see on TV, maybe a book that we've read, if usually based on fear, if we allow that to actually take place and happen and drive our emotion, our decision-making process, we will probably end up valuing data that supports the fear and discounting data that would hopefully lead us toward true financial peace of mind. Well, let's look at some examples of the growth of wealth from 1990 to 2009. We all know what happened. Probably everyone listening to this video remembers 2008 and the very severe economic crisis that we went through. And of course, it reverberated through all parts of the world, the financial institutions, and including the stock market. So you can see here that the S&P 500 from 1990 to 2009, we can see what happened here was growing up. We had problems in around 2001, 2002. Then it recovered somewhat, and then we had the 2008 issue. So what happens then? The media, the financial outlets, they begin to interpret this data for us and to use a lot of fear and scare tactics. For example, as something Wall Street Journal, this is from September 30th, 2008, bailout plan rejected, markets plunge, forcing new scramble to solve the crisis. And you can just see the red line going on almost a straight line down. The Dow down 777 points. the tail of the Dow's largest point loss on record. Of course, it's extremely scary. If you went to the bookstore to maybe escape from it and you're looking at the magazines, look at the New Yorker, October 20th, 2008, at the Grim Reaper. Holding a stock market chart with the red line going straight down and actually blood coming out of the eyes of looks like various Wall Street people. So there's fear and there's anguish, and it's just really, really, really difficult not to allow these negative emotions to impact what we know we should be doing, what we know rationally should be doing. For example, about a couple years ago now, I ran into a doctor at a business event, and we were talking. He asked me what I did, and I told him, and he said, he thought he was really, really lucky because after the crash in 2008, he took all of his money out of the market and he put it into cash, and it's still there. So, I didn't have the heart to tell him at that point. It was just a social, social business networking event. But in reality, what he had actually taken all of the money out of the market, and he actually locked in those losses. And then when the market recovered, which it did, and we're still in still in that recovery period, he never participated in that recovery because he locked his losses in. And why did he do that? He did that because of all the fear that was going around at that time, and allowing that fear to manipulate and impact his emotions, often to make not the best decision.
Years, one of the bigger investment tools was investing in annuities. But given the environment that we find ourselves in right now, is it still the best place for you to park your money or not? Joining us now is Mark Matson. He's president of Matson Money in Cincinnati, Ohio, and Mike Rubino is president of Rubino Financial in Troy, Michigan. Nice to have you here, gentlemen. Welcome.
Nice to be here.
Mark, a lot of people were sold annuities in the last couple of years because it basically gave them guaranteed, in quotes, income. But you have some issues with these particular investment vehicles, and indeed you used to sell some of them, if I understand correctly.
In my earlier, more naive days, I used to be an insurance agent, and hopefully I've learned a little bit since then. Look, none of these products are very good. They all have their own specific problems, but one of the most popular vehicles right now are the indexed annuities. And what they propose to do is give you a market rate of return based on the Dow, with guaranteeing that you're not going to lose any money on the downside. And what they do is they give you the Dow rate of return minus dividends, which is huge because that accounts for a huge portion of the return of the Dow. And then it also strips away a participation rate that's only 70 or 80% of maybe 90% of the return. So if you take away a market return of 10%, you're knocking it down into the 5% range. So it's really very intellectually dishonest, because what it's telling people is, and that's the way they're sold, is that you're going to get a market rate of return, but you're not going to lose any money. And the reality is it protects you from the upside more than it protects you from the downside.
Okay, yeah.
And it's extremely expensive.
Mike, one of the knocks on annuities are the high fees. Why is it worth that in your mind?
Well, quite frankly, Sue, the fees are very comparable to the fees you'd pay with a mutual fund if you're getting help. You can get lower cost fees if you're going to do everything yourself, but when you go to an advisor and you want help with picking your mutual funds, deciding when to get in and out of the market, they're really quite comparable.
I got to take issue with that one. They're nowhere near the same ballpark. In these annuities, you've got 10% commissions up front for life insurance agents that are selling them. You've got any expenses anywhere from 1 to 1.2. You've got, in addition to that, you've got management fees if they're a variable annuity of 1. Then you've got bid-ask spread costs and spreads inside of the annuity. So these things aren't anywhere near comparable to owning a nice no-load. And that's the other option. You don't have to. You can have a nice no-load, no-expense annuity out there, but that's not what people are buying.
The short video that I just played for you, actually, if you looked at when it was actually aired on TV, was March in 2009. So we were still in the midst of this very, very significant economic downturn, and because of the fear that was involved, a lot of investors fled out of the market. They put their money either in cash, or they perhaps were put it in one of these vehicles that locks their money up, that has very high expenses, and that mitigates the ability to fully participate in the recovery, and they often did that because of fear. Now, you can never say that one particular approach is right for everybody, so I'm not trying to say that. I'm just saying that a lot of people, unfortunately, allowed understandably so, the fear that was surrounding that particular economic crisis, that time in our lives, and made some poor business and financial decisions because of it. Of course, you have to always talk with someone that you trust and that can give you really good advice about what's best for you and your family. But if they hadn't fled the market, they didn't put their money in the bank, or they didn't tie it up in some investment vehicle that was going to be safe but not allow them to participate fully in the market recovery, this is what they would have missed, right? Because if we look from uh, January 1990 to December of 2014, the $100,000, of course, which suffered loss in 2008, you can see it on the chart here, would have been worth almost $1 million. So that's quite a recovery, and those people, unfortunately, that sold at the bottom of the market and did not participate in the market recovery, they missed out on that, and that's just a travesty that I hope that people will be very aware of, very conscious of as they move forward, and they won't make that same mistake again. So, emotion-based decisions, like the reality check. So, when it comes to investing, emotion-based decisions, can be your enemy. And the reality check for emotion-based decisions is that we have a natural propensity as humans to make decisions driven by emotions, and it can cause serious long-term financial strife if that emotion is one that is coming from a place of fear and loss. But the worst part is if we convince ourselves that each decision we make is um, purely logical, then the result can be actually unrealistic expectations. So the goal is to be very aware and conscious and ask yourself, is this particular emotion that I'm feeling, is it an empowering emotion? And it may be that the emotion is coming from a place of like, I don't need to take this much risk. I need to take less risk. And that use of emotion can be very powerful, but you just can't let the emotions of fear on one end or greed on the other negatively impact your decisions, because the same emotions that we're talking about work almost in the opposite way. When the market's going up and up and up and up and up, people forget 2008 and they want to take more risks because the market's going up, and they don't really understand that the market will eventually, we will eventually have another period of where the market is good. It's going to go up and down all the time, and they'll want to take more risk because now they're feeling euphoric, and they'll bite off more risk than they can. Then the market will go down and they'll become upset. And this constant seesawing effect of letting your emotions drive your investment decisions can really undermine not only your financial future, but also your current peace of mind. Well, what's the fourth breakdown, expectation breakdown? I call it financial media hype. And financial media hype is investment information that's designed to appeal to an investor's tendency or compulsion to engage in investment speculation. In other words, if you're in the quest for investing peace of mind, many of us turn to various sources of so-called expert information, and the most common places that we seek understanding and enlightenment are the popular media, magazines, newspapers, books, TV, radio, the internet. But what happens is that, instead of offering knowledge and clarity and a path forward, these sources often provide conflicting advice and confusing analysis. Because we have to remember that for most of the financial media hype, it's designed to sell papers, magazines, books, subscriptions to newsletters. The purpose is not to provide you with financial peace of mind, or even to help you create, the financial future that you are dreaming of and that you want. So investors need to be very cautious about believing what they read or hear, lest they wind up with poorly constructed investment portfolio and, I think more importantly, very little investing peace of mind. So, as I said, the financial media is designed to sell products and ideas, not necessarily to help you make good investing decisions. So, if you find yourself becoming more confused, more fearful, lacking clarity or knowledge, then it's time perhaps to find a different avenue to educate yourself. So, the fifth expectation breakdown is overconfidence. Confidence is great. Overconfidence can be good in some situations, can help you break through something, but it can also be damaging in your financial future. So, overconfidence is an undeserved sense of certainty, ability, or skill. And it's the fifth way in which expectations can experience a breakdown. And let's talk about it. This is a really fun activity. I've done this with my friends, and I think it's very interesting. And also, when the first time I saw this, I'll tell you in a second where I put myself, but let's try this little exercise. So I want you to rate yourself as a driver on the continuum shown in the slide. Where do you fall? Are you in the bottom percentile, like 10%, 20%? Or are you in the 50th percentile average? Or are you in the upper half? Now, I found that most people I know say, I'm a pretty good driver. I'm probably in the 80 or 90 percentile. And if you were to do some research about where this little exercise has been given, you'll find that it's really funny that 85 to 90% of the people, of the participants who've taken this exercise, they rate themselves in the upper half of the continuum. So what that means is like 85 to 90% of the people think they're in the top half. Well, that's really not possible, right? Because statistically, we should have 50% of the people, below average and 50% of the people above average. So why do we observe much higher ratings when we ask people to rate themselves? I believe that part of it may be, and I'm not a psychologist, obviously, but part of it is I think that most of us have overconfidence can be a strong contributing factor. For example, why we all know how dangerous it is to text and drive, yet so many people. It's very common for people to overrate their abilities and to think that they are different. The rule doesn't necessarily apply to them, and that they can text and drive. And this can, of course, be extremely dangerous for not only the driver, but people that are in the driver's path. And it's equally true with investments. So this is a fascinating study that I've talked about in a couple of my other workshops. It's called the Dalbar study. And the Dalbar study, it asks like a really interesting question. Well, if the S&P 500, just an index fund, the S&P 500, if it had a rate of return of a little over 11% from 1985 to 2014, then why during that same period did the average equity investor only have a rate of return of 3.79, almost 4%? That's a huge difference between the S&P 500 and the average equity investor. And they asked themselves, well, why is that? Why are so many investors underperforming the market? Now, of course, that's not their goal. Their goal probably is to beat the market. But what if they just got market returns or 11% on the S&P 500? Wouldn't that be better than actually underperforming the market? So it's easy to see though how all of these 5 causes of breakdowns in investor expectation that we've discussed, the hindsight bias, the false pattern, the emotion-based decisions, and the overconfidence, that it can contribute to investor behavior, right? And poor investment results relative to the market. And as a result, the average equity investor only has a return of 3.79, while the S&P 500 had a return of 11%. And so the crucial point I think to get from this study is that an investor's performance does not equal the investment's performance. So let me say that again, that an individual investor's performance does not even equal the investment performance, that when most of us are left to our own devices, we'll most likely underperform the market. Now, Dr. Terrence Oden, he's a professor of finance at UC Berkeley. He's also on the academic advisory board of Matson Money. He looked at the prices of stocks after individual investors bought and sold them through retail brokerage firms, and he published his results in a peer review journal called the American Economic Review in 1999. It was entitled, "Do Investors Trade Too Much?" And what he was trying to find out is he wanted to see if the investors who traded did better or worse, after their transaction. In other words, did the trading help them or hurt them? And it's a very difficult statistical report to read. But if you want to read it, you can certainly look it up. The footnote is there at the source at the bottom of the screen. And but his very interesting to look at the results. So the average returns following the purchase of and sales, so even immediately, they were a negative one, almost 1.5, 1.45. 1 year later, 3.22, and 2 years later, 3.57. So what this is showing us is that people that are making decisions of when to buy and to sell, on average, they're actually doing quite poorly. So, what's the reality check for overconfidence? The average investor has historically failed to beat the market, and chances are, and it's not trying to be negative or say anything poorly about anyone who's participating in the workshop, but chances are you are one of them. And why are you one of them? It's not necessarily, you're falling a victim to some of these various traps that we've talked about. So it's to be, I guess, to be straightforward and blunt, most of us are deluding ourselves if we think that we can consistently beat the market over time. And so that brings us to our sixth expectation breakdown. Why is that? So psychologists call this the necessary lie syndrome, and these ideas come from behavioral finance. They're not things that I've made up or that I have come up with myself. What I've read about and studied, and behavioral finance is fascinating area of study. So these necessary lies are a justification that we all do, that we apply to our imprudent behavior. So lies is kind of a strong word, but we're lying to ourselves about something is really what it's saying. So necessary lies are the seemingly harmless little things that we tell ourselves when we're doing something we know we shouldn't do. So, we sense when we're involved in a behavior that might be considered reckless or irresponsible. Let's go back and look at the example of the texting and driving. We know it's a serious problem. We have all seen and heard of horrendous stories where people have been texting and they've either killed themselves, they've killed other people, just horrendous. Yet, actual texting and driving seems to be on the increase. Well, why is it? Well, we tell ourselves little lies that are necessary to justify this imprudent behavior. We'll tell ourselves, for example, well, I'm really quite a good driver, so I'm a better than average driver. I'm a really good driver, so I'm going to be able to handle it. Or I'm just going to text for a second, or I'm just going to glance down at my emails and see what's going on. So, but we know that we're internal voices whispering to us that we're breaking the rules and probably shouldn't do it. So a natural response is some sort of attempt to rationalize or justify our actions. So even if we're only talking to ourselves, I think we're all hardwired to excuse and defend our own behavior. So texting and driving is one example. Well, another example, overeating. I have to fight this. It's very hard for me. I love to eat, and I'll say, I worked really hard today. I deserve it. Or I might say, well, I'm going to go work out tomorrow, so I can have that sixth piece of pizza and ice cream sundae after tonight because I'm going to go out and work out tomorrow. Or, you often hear, I'll start dieting tomorrow. Um, those people, there are a lot of people that struggle with drinking, and what they'll say is, I can handle it. I'm really not having any trouble. One more is not going to make a difference. People that have some sort of gambling issues, they just say, I'm just going to stay gambling until I can get even, just break even, and then I'll stop. Of course, they never do. And it's the same thing with investing. You often hear this, even if you watch the TV talking heads, financial talking heads, or read magazines. They say, well, this time it's different, but it usually is not and has not historically been different. So the remedy to the necessary lie syndrome is actually being conscious, being awake, brutal honesty. If you ever hope to be a realistic investor, then you must be willing to you must be willing to look at and see these necessary lies that we tell ourselves, and we all do them, every single person in different areas of our life. So think about your own investing situation. Have how long have you been fooling yourself? Have you fooled yourself, right? So, in what ways have you been investing imprudently while convincing yourself that this time it's really different or this time you are able to handle it? Um, do any of the crystal ball illusions, stock picking, market timing, track record investing, free lunch illusion, do any of those play a role in deciding that this time is going to be different? What about the expectation breakdowns we've discussed? Do any of those apply? So, by not being conscious of this investment behavior issues that plague all of us because we're human, it can lead us to diluted investing. And the reality check for the necessary lie syndrome is that these distortions or these lies we tell ourselves can lead to diluted investing. So in fact, as we look back over these 6 expectation breakdowns, whether individually or in combination with any others, these breakdowns lead to investment decisions and results which are misaligned with their expectations. And it's this misalignment, generally, at least on one level, that can lead to anxiety and worry. So, what are recommended steps to overcome these perception biases? Self-realization, another way of saying to stop and think, be conscious, and ask yourself and become aware and see, which of these behaviors that you may be engaging in. And also, at the same time, don't be too hard on yourself because you're human, right? But just by seeing it, and once you can see it, then you're able to move away from it. Ask for assistance. Read great books. Talk to someone who understands behavioral finance, and it's very, very helpful if you can experience some of these things in a community. For example, someone that you can talk to, and just share that this is a problem. And also, I think what's really, really crucial is that you learn to ask the right questions. The problem with this discussion is that so often it creates more questions and answers for you, and I believe that many of the answers that you need, that you have to reach on your own, but certainly you can go with a guide or you can go with someone who's a little more experienced than you on the path and they can show you. But I believe that if you know the right questions to ask, then you're gonna be light years ahead on your journey toward investing peace of mind, because it's not so much the answers, it's knowing the questions. There's so much information out there that the questions help you formulate it, and they help you take the facts and the information and move toward knowing what to do with it. Some people would say that take the knowledge and move it toward the continuum of wisdom, knowing what to do with the knowledge. Well, let's begin then looking at the 20 must answer questions for your journey toward investing peace of mind. Now, the questions are relatively easy in the sense that they all have either a simple yes or no answer. But the catch is that the answer must be 100%, otherwise it's no. And don't feel bad if you don't get many of them right. It's totally fine. It's just a baseline to determine what areas that you need to work on. So the first question: have you discovered your true purpose for money, that which is more important than money itself? It's not enough to know that money is not the most important thing in life. To actually get a yes on this question, you have to be able to know what is most important to you, that which is more important than money, and that which is more important than anything else in life. If you know that, then say yes. If you don't, just write down no. Number 2 is pretty straightforward. Are you invested in the market? Meaning, do you have equity stocks or do you have at least equity-based mutual funds? Most people usually get a yes to this because most people have some money in the market, whether it's in their 401k, in their pension, or in their personal investment accounts. Do you know how markets work? I talk to investors all the time and they have money in the market, but then when it comes to understanding the underlying dynamics of how the market works, they don't know. I would think it can be very disconcerting to have a portion of your wealth invested in a way that you don't really understand. If you know how markets work, yes. If you don't, no. Have you defined your investment philosophy? Now, we all know that whether it's religion, education, science, or history, your philosophy is absolutely imperative to making decisions that are right for you. And as we discussed today, there's various philosophies of investing. There are some people that believe that, looking at the crystal ball, stock picking, track record investing, market timing, and there are other people that don't believe or don't follow that similar philosophy. So once you're able to identify your investment philosophy, it's only then you'll be able to design investment strategies that support that philosophy. Question number 5. Have you identified your personal risk tolerance? In other words, have you thought about it consciously and made a decision about how much and what type of risk you want in your portfolio? Or do you have a smorgasbord approach where one year this investment looks good, another year that one looked good, and over the years you just kind of haphazardly built a portfolio with risks that you really don't even know or understand that may be lurking in your portfolio? Do you know how to measure diversification in your portfolio? So do you know how well or how poorly you're diversified? Do you consistently and predictably achieve market returns? Answering yes to this question would require a couple things. First, some historical knowledge of the market and actual market rates of return. There are benchmarks you want to look at as you build your portfolio because most people don't know what markets have done historically and they have no idea whether they've achieved market returns or underperformed. Statistically, as we talked about in the Dalbar study, the vast majority of investors underperform market rates of return. Have you measured the total amounts of commissions and costs in your portfolio? Many people are totally unaware of what it's really costing them to hold certain positions, certain mutual funds inside their portfolio. Do you know where you fall on the Markowitz efficient frontier? So Markowitz won a Nobel Prize in 1990 because he was able to determine that you can actually identify portfolio volatility by looking at historic rates of return and asset correlation. You could then use modern statistics and analysis to create a portfolio that optimizes, that's efficient, the potential return for whatever level of risk you're willing to take. I think that to pursue successful investing, it's critical to know where you fall so you can measure your rate of return against the risk you're taking. So question number 10 is pretty straightforward. When it comes to building your investment portfolio, do you know exactly what you're doing and why? So this is the first 10 of the 20 must answer questions. And if you're not doing that well, don't feel bad. Again, it's not a test in the traditional sense. I've done this test for groups of attorneys, other financial advisors, and many of them are now only able to, who are somewhat in the business or in a related financial legal business, can only get 3 or 4 the first time they take the test. So, question number 11. Are you working with a financial planner or a financial coach? If you're working with a financial coach, it helps you focus on answering the 20 must answer questions or questions like this that we're talking about today. Then you'll know, am I working with someone who's trying to really help me on my path toward financial peace of mind, or are they just trying to sell me some product? Do you have a customized lifelong game plan to guide all of your investing and spending decisions? Now we're talking about a way of looking at everything that's valuable to you, your life goals, your assets, whatever it may be, and actually planning out what you want to do with your life and your money so that when you comes to the end, you can be like Ebenezer Scrooge and say, at the end of anyway of the Dickens story, that you've lived your life without regret. Do you have an investment policy statement? That's simple. Either yes or no. 14. Have you devised a clear-cut method for measuring the success or failure of your portfolio? What is your measurement tool to know if your portfolio is doing what it's supposed to do? 15. Do you fully understand the implications and applications of diversification in your portfolio and how to build it into the portfolio to make sure that your portfolio truly is diversified? 19 asset classes and global representation. Do you have a system to measure portfolio volatility? If you do, yes. If you don't, check no, please. Are you aware of the costs associated with purchasing commission-based products? Now, let's face it, commission-based products require trading to generate the commissions, which very often can encourage speculating with your money to support the commission industry. Question 18. Do you know the 3 warning signs that you may be speculating with your money versus prudently investing it? It's very difficult for most people to know if they are investing prudently rather than speculating because they often have no way to distinguish between the two. Can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? Often, our individual mindsets and beliefs about money are not things that we developed as adults. Many come from childhood. Many are actually we've had since ages of 4 or 5, and they're so much a part of us, we don't even recognize them. And question 20. Are you ready to shift your personal experience of money and investing from a scarcity mode to an abundance mode, where you can live your life rather than obsess about your assets? I've often seen that people suffering from portfolio losses and lack of diversification, excess costs, feel that they are in a state of scarcity, not enough time, not enough money, not enough investing peace of mind, not enough clarity, focus, and capability to move forward into the future. I think of all 20 must answer questions, this is the most important one that you have to be first make in order to begin making progress. So, are you ready to begin to shift your experience of your portfolio, of your money, from a scarcity mode to an abundance mode? One in which you live your life rather than obsessing about what you don't have or your assets? If you can answer yes to this last question, then I think you're ready to take the necessary steps to create abundance in your life. And I would love to hear from you. Feel free to email me, to call me at my office, to schedule an appointment, whatever I can do to assist you. And I want to thank you again for taking the time to participate in this investor education video. The topic today is not necessarily an easy one, it was a heavy one, but I hope you found it helpful and that it provided you with some steps that you can take to create greater investing peace of mind for you and your family. Thank you again.